Hello, everyone. I'd like to welcome you to the kickoff of the Wyoming Stampede and Hackathon. This is the first in a series of talks we're going to have leading up to our big September event. And I'm very pleased to have the speakers we have today. But what I'd like to do first is I'd like to introduce Dr. Ali from the University of Wyoming. He is our endowed chair of banking and was responsible for putting this together for us today. So with that, Dr. Ali, if you could please introduce yourself and then introduce our speakers. Thank you so much, everybody.
Thanks, Steve. Good morning, everyone. Thank you for joining us today, this early hour in Wyoming or wherever you are. We are extremely happy to have you with us. On behalf of Culture Business and the Center for Blockchain and Digital Innovation here at University of Wyoming, I welcome you all. I am very delighted to have Dr. Thomas Moser, the alternate governor at Swiss National Bank, as our distinguished keynote speaker today. And also I would like to thank Professor Lupin for putting all of this together. He's our director of Center for Blockchain and Digital Innovation. And as Steve said, a lot of great things are coming up. And my special thanks goes to our distinguished panel. We have with us today Ms. Katie Long from Avanti Bank and Trust, as well as Commissioner Faulkner, who have kindly agreed to join us today as the panelist. And after Dr. Moser's talk, they would come in and help us answer questions and give their comments. And with that, without further ado, now pass the mantle to Dr. Moser. Dr. Moser, the floor is yours.
Thank you very much. Good afternoon from Zurich. I'm very pleased to be here. Thank you for having me. Let me try to, it's always the difficult part, to get the screen up and share my presentation, because I prepared some slides. Can you see the slides now? Not sure if it works. No? Okay, let's try again. Is it better now? Can you see the slides? I don't hear anyone. Can anyone tell me whether the slides are up? Okay, I'm not sure whether it works. Hello? Is it? I'm not getting any responses here. Is it no slides? Okay. Because I don't see the chat right now. So if anyone could quickly give me an audio, okay, if the slides are visible. Or if they're not visible.
Tom, we have it. It's working.
Okay. Thank you very much.
Thank you.
So sorry for that, but that's always the most difficult part of each talk to get, because there are different applications. They have different sharing versions, and so I'm glad it works. So I will talk about retail central bank digital currency, and as I said, very glad to share my thoughts here. So let's start with types of money. And I think if we talk about central bank digital currency, it's always important to say first what central bank money is, because not so much about among economists, but sometimes you get confusions between stable coins and central bank digital currency and so on. So let me just put out the way it works right now in the non-digital or in the pre-CBDC world. So the central bank here in blue basically creates two types of money. We have the bank notes here shown on the left that are available to the public. And then the central bank also has reserves or bank accounts, but these accounts or deposits are only available for financial market participants, mainly commercial banks. So those are the only one nowadays who can hold central bank money in digital form. They themselves then use these accounts as reserves and issue then deposits to the public. So the public pays usually either in banknotes, in cash, or with commercial bank money with the deposits that they have with commercial banks. So only the blue stuff here is central bank money. The green part is private money, because sometimes you also hear people say the new thing about cryptocurrencies is that it's privately issued money, but we always had privately issued money. Privately issued money is the money that you pay with most of the time. It's the commercial bank deposits that's also privately issued. So that's not the new thing. And then we have, of course, cryptocurrencies since Bitcoin. And there it depends a lot exactly how it is designed. In the case of Bitcoin, there is really no issue. It's the system, the blockchain that issues, or the protocol that issues the currency. You have other forms where you have a entity that is issuing, especially in the stablecoin area, but they're very different schemes. So if we talk about central bank money, or CBDCs, central bank digital currencies, there are basically two possibilities that are usually discussed. One would be a so-called wholesale CBDC, and that would be the same concept again as here. You would just have the like you have now bank deposits for commercial banks. You would have a CBDC, tokenized form of central bank money, but only available to selected financial market participants, banks. You have a lot of pilots going on. The Swiss National Bank had a pilot as well, pilot called Helvetia. You will find the documents on the BIS website. The Bank of Canada had a very famous first project called Jasper. So, and Singapore had one with Ubin. So there are a lot of pilots going on there. And the big question there is, would that be more efficient than the traditional financial market infrastructure currently in place with central banks, mainly their RTGS system? So it's payment among the banks. It would not be something for the public at large. It would also not be that disruptive because, as we have seen, banks already have access to digital forms of central bank money right now in the form of these deposits at the central bank. So what we are talking about here, and which is much more revolutionary, would be a digital form of central bank money for the public, so-called retail CBDC. And central banks are much more cautious with retail CBDC than with wholesale CBDC. And one reason here is because they are entering a field now, namely providing digital form of money to the public that has been reserved for commercial banks so far. So there, one of the risks that is often discussed is the risk of disintermediation, meaning that people will switch to CBDC, retail CBDC, and not hold money in the form of commercial bank deposits anymore, or much less. And that, of course, will then get or affect the funding of commercial banks, which could have larger effects. Now, you find a lot of counter arguments in the literature. One is that says, well, the central bank's getting all this funding now because people are holding retail CBDC. They can just give the funds back to the banks, so that's not really a big issue. And some even say, that's a good thing because you get competition for the commercial banks, and they have to change their business model. Especially, they have to become much less risky for people to continue to hold money in deposits. So it will improve the overall stability of the system. But these are, as I said, a lot of theoretical arguments. There are some concerns here. It would certainly change the landscape. There are other proposals that say, well, the trick is just to make CBDCs less attractive, especially hoarding less attractive. Make sure that the CBDCs are only used for payments, but that they are not used to hoard money. And for instance, you could have a lower interest rate or even a negative interest rate on the retail CBDC, and so on. So there are different discussions about how you could address this risk of disintermediation. Now, another issue that is often, especially also when I talk to people at the Swiss National Bank itself, a lot of times the question comes, okay, retail CBDC is nice idea, but what do we gain with that? Is there anything that people cannot already do nowadays? If they want to make payments digitally, they use their commercial bank account. So why would you need a digital form of central bank money? Now, I will talk a little bit more about that later. One reason that you could mention is that central bank money is the only form of money with no counterparty risk and no liquidity risks. So you could argue that you provide the public with a sort of money that is less risky than commercial bank money because it doesn't have this especially credit risk involved. And the other argument that you could make, especially with a proposal I will show you later, is that you could actually provide a means of payment that gives you privacy. So far, if you want to make a private type of payment, then you only have banknotes to do that. Now, this has pros and cons, as everyone knows, but in the digital field, that's not possible. But there are ways you could provide that possibility, and I will talk about that a little bit more. Now, what I just said, that central banks have been more cautious about retail CBDC. You see a little bit here. Although that changed a lot over the recent months or years. That's a picture from the Bank for International Settlement. It's not up to date. You see, it stops there in 2020. But what you see here is the speeches that central banks gave about CBDC, and you see in dark blue, you see speeches that were positive about retail CBDC. In light blue, speeches that were positive about wholesale CBDC. And then on the red color below, you see dark red speeches that were negative about retail CBDC, and in light red speeches that were negative about wholesale CBDC. And you see that first, almost all central bank speeches were negative, especially on retail CBDC. They are still negative, but at the same time, starting from 2018, 2019, you see a growing amount of speeches that are positive, both first on the wholesale, but more recently also on retail CBDC. So there is central banks have been changing their minds. They have also been studying it much more and have become more, I think, more positive towards retail and wholesale CBDC. Now, another point to make here, and I think it's an interesting discussion, is if you look at payment systems, there are basically two ways how you can make payments. There are so-called account-based systems, and there you pay by transferring the monetary value. In that you charge the payer's account and you credit the payer's account. That's when you pay with your bank deposit. It goes from one account to the other. Now, what's necessary for such a system is that the people involved are identified. So you need to know whose account that is. It can be instead of a real person identity, it can be a number account or something like that. But you need to identify the owners of the accounts. That's crucial in that type of system. Unlike in a token-based or a value-based system, that's the classic cash system where you pay with banknote. There, the transfer occurs by transferring the value itself or a token that represents the monetary asset. And in that case, you do not need to identify the people involved. They can remain totally anonymous. The only thing that needs to be verified is that the banknote token is real. It's not a fake token, but you don't need to know anything about the people. So if you want to have a system with total privacy, then you need to have a token-based system. In an account-based system, it's very difficult to achieve that, or even impossible. So the key, and now why I stress that is you find some people, including a very nice article of the New York Fed, they say, well, this differentiation doesn't make sense in the digital world. I tend to disagree here. I think it is worth to keep that difference, and it's a difference about the information that is carried by the asset. And in an account-based system, as I just said, the asset is the account and it's associated with the transaction history. While in a token-based system, the asset, the value carries only the information about its value and its entity that issued the token, but there is no transaction history. There is no link to the people involved in the payments. And why do I stress that? It's because, and that might be controversial with some people, but the distributed ledger is an account-based system. The only new thing here is that the ledger is distributed. It's not centralized, but also here you have accounts. When you look at Bitcoin, the public key or what you make out of the public key gives you an address. So the accounts are identified with addresses. So this is also an account-based system, and it's very difficult to get privacy in such a system. Now, how would you go about to create the CBDC? Now, one of the most simplest proposals is that you say, well, you just give, like you have now accounts for commercial banks, you just give everyone an account at the central bank. You have a number of papers proposing that. I list them there. That's a very simple solution. You just give everyone an account at the bank. Now, of course, there are some drawbacks here. One is that central banks do not really want to go into the retail business, and especially they do not want to take over responsibility for know your customer checks, KYC, and AML, anti-money laundering, and counterfeiting terrorism regulation. Some people say, well, that can easily be outsourced, so the central bank doesn't really have to deal with that, but it would be responsible still. Another drawback that you hear sometimes is that gives the central bank or the government the potential for mass surveillance because you have a lot of data here. Payment data is anyway a type of data that gives you a lot of information. You do not only find out what people buy, what they are doing, you also find out where they are during the day because it's connected to a location. So it gives you a lot of data, and that's all centralized within the central bank, and that gives at least the potential to have mass surveillance. And now some people say, well, the central bank, is independent. So the government, if the government wants to have that data, it cannot have it that easily. I would say here, well, it's at least a threat to central bank independence because if the data is there, there might also be an urge to use that data. And the other drawback, of course, if you do a CBDC in that way, that is a clear direct competition with commercial banks. So that's a sure way to get disintermediation, or that's the most likely way where you get a disintermediation, because you can choose them whether you have your bank account with the Federal Reserve that cannot go bankrupt, or you have it with a commercial bank where there is at least some risk involved there. Now, the other way to go would be token-based CBDC. Now, the problem with a token-based CBDC, and I'm not talking about DLT here, because DLT I count among account-based systems. A token-based would really be the equivalent to a banknote, where there are no accounts involved, where you have a real digital token. Now, the big problem, of course, with a pure token system is how do you avoid that people just copy the token? And that's a problem that is basically unresolved. There are some hardware tokens, but they also can be attacked. And you have a pure software token, that the so-called double spending problem is a huge problem. And the other one, of course, is if you do that and you allow anonymity, how do you get the know your customer and anti-money laundering compliance with such a system. Now, the blockchain, as I said, I count that under the heading of account-based systems. Now, the challenge with blockchain or DLT, distributed ledger technology, is one is, of course, the consensus mechanism. If you distribute the ledger over several participants, over several nodes, then the difficulty is to synchronize the distributed ledger. And that, interestingly, was in distributed computing was solved for closed networks. So there were consensus mechanisms that existed already before Bitcoin, but only for closed networks. What Bitcoin did, it provided a solution for an open network, meaning that for a network where participants can choose to join, they can drop out again. You do not have control over who is in the network and who is not. So that's much more difficult to achieve. Bitcoin, and I think that was the genius about Bitcoin, achieved it with the so-called proof of work, with the consensus mechanism that was new, together with an entire incentive system that makes this blockchain work. And it works. I mean, it works since over 10 years. I think if you would have asked an economist 15 years ago whether something like that would work, I would guarantee you the majority would have said it doesn't work. Well, it does work. So you have some of these open networks or permissionless ledgers, as they are called, the two big ones, Bitcoin, Ethereum. But more and more you have closed networks, and most central banks that are considering CBDC with a DLT, with a distributed ledger technology, or all of them go for a closed network, for a so-called permission ledger, where you do not allow anyone who wants to join the network. You have a relatively small group who is allowed to run a node on that ledger, and that's how you make it much simpler. It's much more simple consensus mechanism that is required if you have a relatively small group, especially also if you know who the participants are. You identify them, and you can also basically punish them if they don't behave the way they are supposed to behave. Now, but you also see within the last maybe 2 years is a standardization of types of distributed ledgers that are being used, and the two most used ones are Corda, provided by R3, and Hyperledger. So most of the central bank pilots that you hear about are done either with Corda or with Hyperledger. So these are more or less now standardized DLTs. Some people in the blockchain scene would tell you this is not a blockchain because it's a permissioned closed network. It's fairly centralized. So the whole idea originally of a decentralized system is gone. So, but that's a philosophical question. But in general, it shows you the so-called blockchain trilemma that Vitalik Buterin, I think, was the first one to mention. And in a blockchain or in a distributed ledger technology, you have this trilemma that you have these three goals that you want to achieve: decentralization, scalability, and security. And the blockchain trilemma says you can only achieve two at the same time. You cannot achieve all three at the same time. Now, Bitcoin chose decentralization and security, and it's very good at both decentralization and security, but it's relatively bad at scalability. And of course, if you want to commercialize it, and that's what a lot of, especially Corda and Hyperledger are doing, and the central banks are trying to achieve, is you want to have scalability. You want to have more than 7 transactions a second that famously Bitcoin achieves on the blockchain. And then you have to sacrifice either decentralization or you have to sacrifice security. What these closed networks do, these Corda and Hyperledger types, is they sacrifice decentralization. They get more centralized, but they then therefore gain scalability and they keep security at the high level. Now, there are a lot of attempts right now to get also the permissionless ledgers more scalable. Ethereum right now is going through a major update, and they try to change the consensus mechanism They tried to introduce sharding, where you basically partition the blockchain to some extent. And there you sacrifice a little bit security, but not decentralization. That's the goal of these open networks, to stay fully decentralized. But that's a very interesting field. There's a lot going on. Bitcoin is also trying to scale by having a lot of transactions off the chain through the Lightning Network that starts going live, where you basically have all the retail little payments off the blockchain and only have the bigger payments, larger payments on the chain. And something similar is proposed for central banks. If you look at some of the retail CBDC proposals, for instance, the one that Sweden just issued, I think yesterday the report came out, that goes in that direction, that you have a closed permissioned ledger where only the commercial banks participate, but then the peer-to-peer payment you basically have off the chain to gain that efficiency or that scalability. Now, the question that we came up, so I wrote a paper together with David Chaum and Christian Grothoff, and basically I saw that David Chaum came up with he's the father, you can say, of cryptocurrencies. He was the first one who had the idea to combine or to use cryptography to create digital money. And he wrote the paper in the 80s, so very, very early. And he had a solution that he actually implemented in the 90s. And his goal was to have a system where you could make payments over the internet. But as we all know, that didn't really take off. What became the main means of payment on the internet were credit cards. So people forgot about that system. And then when I met Christian Grothoff, who basically updated the eCash idea of David Chaum, I said to him, well, why do we not see whether we could issue a CBDC that way? And that's a fully centralized way to issue a CBDC. I mean, if you need scalability and if you can only achieve that by decreasing decentralization quite a bit, why do you need to have DLT technology at all for retail CBDC? So my thinking is a little bit, you can easily do a CBDC without DLT, and you actually save yourself a lot of troubles, especially the scalability issues. And that's what we did. It's a paper we published. You will find it, if you're interested, on the website of the Swiss National Bank. It's a working paper. It's called How to Issue a Central Bank Digital Currency. And we also got David Chaum to participate, which gave me a lot of pleasure, given that he really is the father of crypto currencies. So what we are proposing, we propose a retail CBDC that is really token-based. There are no accounts involved. It's centrally issued. There is no DLT. And what you gain with that, it is extremely efficient and cost effective. We can do the same thing that modern real-time gross settlement systems do. So at the fraction of a cent, we can make thousands of transactions per second. The other thing is we designed the system as closely as possible to banknotes, which means that it's also distributed through the banks. That's the two-tier system that most proposals now also include, and that should make it sure that you are not having too large of an impact on monetary policy, transmission channel, or financial stability. It's the same way as with banknotes. You have to go to the bank. You need to have an account. I will show you that in a second to get your CBDC, and it should not have a major impact on the financial system, at least not like as a shock. It can have, of course, an effect over time. The other very special thing about the scheme that we are proposing is that it guarantees privacy for the payer, and that's important. It doesn't promise privacy, so it's not achieved through organizational measures that you make sure who has access to the information, who not. It guarantees your privacy, and this is achieved by another invention of David, by blind signatures. And but then also we make sure that it is compliant with KYC, AML, CFT rules, and I'll show you in a minute how that's done. And the last part, it's open source software. We think it's also important for a CBDC to have the transparency, accountability, and also some of the security advantages, because people can actually see what's in the code. Now, the big picture of how that works is, as I said, like nowadays, if you want to get cash, if you want to get a banknote, you have to go to your bank. You need to have a bank account, and you withdraw at the ATM, for instance, your banknote from your account. So that would be exactly the same. Why that? It's because that's the way that you get the KYC AML compliance, because it's the bank's job. If you have an account, you have gone through these checks, and you can withdraw the money from there, so that it's clear from where these funds come, and you can withdraw your CBDC. What's very special in our system is that the blinding that I talked about before, this blind, what happens basically is that the CBDC is a number. It's a very large number. And if you want to have privacy, you have to make sure that neither the commercial bank A nor the central bank knows which number that you are withdrawing, because if they see your number, they can also see what you spent it on. So what happens in our system on the lower left is that the customer who is withdrawing a CBDC, he actually takes that number and he blinds that number through cryptography, and then sends it blinded to the commercial bank. The commercial bank sends it blinded to the central bank. The central bank signs it, never sees what the number is, gives it back to the commercial bank, and that all happens within a second. And the commercial bank gives it to the customer, and the customer unblinds it again. So sometimes we hear, well, that will not work, because who guarantees you that the central bank is blinding it or the commercial bank is blinding it? That doesn't need to be the case, because it's the customer who blinds the number. So neither the commercial bank nor the central bank ever see it. So when the customer spends it and buys something from a merchant, no one knows who that was with that number. That you cannot follow back and see who withdrew that a specific coin and paid something or bought something with it. Now the other thing is now the merchant, and then I told you before, the problem in a token-based system is you have to make sure that it cannot be copied, and that is extremely difficult to achieve, almost impossible. So in the scheme we propose, we do not even try people from stopping to copy it. The way that works is that the merchant, if he receives this CBDC, to make sure that this is not copied, that this is not a coin that has already been spent before, the merchant has an incentive to immediately deposit the CBDC with her bank. And only at that time, when she deposits the CBDC with the bank, then it goes to the central bank. The central bank checks whether this coin has already been spent. So the only thing that the central banks keep is a list of coins that have already been spent. There are no people attached to it, no transactions attached to it. The central bank checks that, and if the coin has not been spent, then it's accepted. If the coin has already been spent, it's not accepted. But that's how double spending is checked here. So it's really incentive-based, that the merchants have an incentive to deposit the CBDC immediately. That's how double spending is avoided in a purely token-based system. And let me wrap up here. As I said, it builds on the eCash idea of David Chaum. There have been some improvements here. You will find all the cryptography in the paper, which actually has been a little bit of a challenge, because as economists, we are not used to number theory. So we are not used to the notation of number theory, especially modular arithmetic. If you talk to cryptographers, and both of my co-authors are cryptographers, they said, well, this is, that's child's work. We are not going to explain that in the paper. This is something that you learn in the first year of computer science. And I told them, well, economists are not you. They don't know what modulo n means. And so I did write it up, and I hope so. It's good explained for economists. So if you want to take a look at the paper, it's also a way to get a little bit familiar with cryptography that should be relatively friendly for an economist. And as I said, you will find all these details in there. Maybe one thing that I should now mention is that that is a bit special about the CBDCs. We also have, and I mention it because I just read that the Chinese version has something similar, and this is an expiration date. We have also an expiration date of CBDCs, which means that you would get a certain amount of time to exchange your CBDCs if you're still holding them for a new CBDC. That could be chosen by the central bank. It could be on an annual basis. That could be on a shorter basis or on a longer basis every 5 years. It's a little bit similar with banknotes. Once in a while you get new banknotes, a new series, and people have to exchange them. So that's the same thing here. Why it's done? It's done basically for 3 reasons. One, it's if you have an expiration date on these coins, then the central bank, as I told you, with that list of spent coins, doesn't have to keep an ever-growing list of coins, which makes it longer and longer to check the entire list every time. You can keep the list at a certain length, and it makes it much more efficient as a system. It also reduces the risks because you do not have to worry about attacks against expired coins. Also, if the private key that is used here would be compromised, then the window to abuse that for the attacker would be smaller because there is an expiration date. And that's now what I read why the Chinese solution has that involved. Actually, you could encourage people to spend it, or you could use it to ask for to charge an exchange fee when you exchange them, and that's a way how you could implement negative interest rates, and that's nothing else than what Silvio Xell very long time, more than 100 years ago, proposed, and what John Maynard Keynes in his general theory mentioned, that very obscure carry tax on money, but that's how you could implement it. You don't have to. So this is just an option that you would have with the system. You do not have to charge an exchange fee. But if you wanted to do that, that would give you a possibility to do that. And let me end here.
Thank you so much. That was a fantastic talk. My first takeaway is that the way we teach math to college students, especially business students, should change, and quite a bit of number theory and other things should come in. It is my distinct pleasure now to bring our panelists online, Commissioner Faulkner and Ms. Long.
Good morning.
Good morning.
Good morning. So, Commissioner, what's your take?
Well, thank you for the opportunity to speak about this. It's definitely on a much more macro level that a state regulator normally thinks about, but in the role that I have, I've kind of got a foot in both worlds, if you will. What is the practical application of a CBDC? How does that work? What do our community banks and their customers, how do you blend that together? I thought it was very interesting. Dr. Moser's one of his early slides that showed the trend in the comments about CBDCs, and I can tell you very much from personal experience that's absolutely the case. We've been in the kind of the digital assets space here in our division for about 3 years, pretty active, and my conversations with the Federal Reserve officials, whether it's staff and even some governors, that trend has changed quite a bit in the last 2 years for sure. We had some probing questions, a little over 2 years ago, and I won't say they were dismissive, but you could tell it wasn't necessarily a priority, and we've seen that shift change here in the last 12, 18 months, and so I think again, as we look at this and what's the benefit? What are we trying to accomplish here for our society, right? And then where are the trends going? As a regulator, of course, I also want to know, are the banks equipped to make this transition? And are their customers ready to make the transition? And where is that line? I don't know yet. We've got a lot of wide open rural spaces here in this country and really around the world. There's some real benefits to going towards the central bank digital currency. I think there's still a lot of discussions, education, convincing of what's the real utility. If I'm a farmer in the middle of Wyoming, why do I care? Right? I've got cash in my wallet. I can go down to the local cafe. I swipe my debit card when I'm paying for supplies. Where are we headed with this? Why do I want to do that? And I think that's the next piece of this puzzle. The technology and the math behind it is being figured out. I think as we'll continue to have these dialogues in the very practical applications of implementing kind of a CBDC and what that means for the U.S. on a global stage and then internally within our borders.
Thank you. I think we have a question that may actually be related to some of the things that you've said. How do you feel this is going to change the sort of saving rates at different income levels? Would it improve, saving rates in the U.S., which has been endemically low, or not?
That's a good question. I'm not sure. I don't know. I think it has the potential to, if you think about more macro, free up, capital. But again, take that down to the individual level. Does freeing up capital on a macro level, does that trickle down to the individual and a savings rate? I'm not sure. I'll have to think about that one. So I'll just go ahead and dodge that question and maybe pass it on to Caitlin on that.
Great. Well, Ms. Long, what's your take on the talk?
On the talk, that was fantastic, Dr. Moser. It's very clear you've done your homework, and I do have to commend the Swiss National Bank for being what I consider the most crypto-friendly central bank in the world. I know China gets a lot of attention, but oh boy, if you really look at what Switzerland has done, it's been just incredible. The banks in Switzerland can take crypto deposits. Even in Wyoming with our special purpose depository institution, we didn't go that far. The deposits on the balance sheet are still fiat currency dollars in the case of the U.S., but in Switzerland, it's rightfully so. I think the Swiss National Bank has respected the developments in these other monies and looks at them as just another currency or another commodity, which is exactly right. And that's why so much innovation has flourished. And that's why I think the Swiss National Bank can be out ahead on these particular topics. Also, the Swiss National Bank is the first of the major central banks that has authorized the issuance of a Swiss franc stablecoin. Those have been pretty small. They haven't broadly tipped in usage yet, but the precedent was set, and the collateral is stored directly at the Swiss National Bank. So if it's okay, Dr. Ali, I'd like to ask Dr. Moser about that, because there's been private sector innovation in the banks in Switzerland on this very topic because they've been able to be out forward in advance. And how would the issuance of a central bank digital currency by the Swiss National Bank impact or be influenced by what the private banks have done?
I think that's a very good question. So maybe first I have to say that it's not just the Swiss National Bank. We were a little bit free riders and also forced into that because the innovative scene that you said that actually started first. And we had Ethereum with Vitalik Buterin moving to Switzerland. Mm-hmm. And we have something called Crypto Valley in Switzerland where a lot of innovation is going on. So both the Swiss National Bank and our regulator were forced to look at these issues very early on because there were concrete business proposals coming out. Mm-hmm. And as you said, the stablecoin is an interesting thing, because that's also the way we dealt with fintechs, because most other central banks told the fintechs you have to go through the commercial banks into the RTGS, into the payment system. And we said from the beginning, well, to create a level playing field, if a fintech gets a license, so we have a special fintech license, if they get a license, why force them to go through the commercial banks? Let them have directly an account, just like a commercial bank at the Swiss National Bank. And the stablecoins you referred to was exactly such a case. And that's actually a fully licensed bank. And they just use their bank account with the Swiss National Bank to issue a stablecoin. And as you said, I mean, we were... it's interesting that there's no more attention on that, because that's a hotly debated issue. When I talk to my colleagues from other central banks and they find out about that, they usually say, "And you allowed that?" Yes, nothing happened so far. But to your question, I think actually that's so. When I said before, and I'm convinced about that, a CBDC doesn't need a blockchain, but a blockchain needs a CBDC. And I think the CBDC, especially available on a public blockchain, would be a killer app. A lot of the stable coins, I mean, the demand for stable coins shows you the demand for a stable type of digital currency. And it's also interesting, you hear a lot of anti-central bank rhetoric, but all the stable coins, what do? They peg their value to the US dollar.
Right.
So basically, they all trust into the Fed to keep the value stable. And if the Fed would issue CBDC, that would be something that would be widely used in the crypto scene.
So I think a kind of related point that is coming through the feed is that do you think that that's something like a retail CBDC needs to offer a competitive yield in order to be, valuable to the mass market, especially vis-a-vis stable coins and other things that can compete more effectively without a yield?
You address
the question to everyone.
Well, also, I guess from my point, if you think about the psyche of money and interest and yields and rates, my gut reaction would be yes, it does, because again, I think that's something that as people look at various asset classes and then just the role of currency, I think that's something that would have to you need there to make it attractive. I mean, there's efficiencies obviously gained with it and the technology behind it, but my reaction would be that I think you would have to have something like that to add to the utility of the CBDC.
So let's switch gear a little bit. If I go back and try to remember my history well, the creation of bearer notes at the Bank of England, a few hundred years ago, was a great innovation to basically take essentially perhaps create the first distributed ledger. In order to, the Dutch and the Swedes experimented with membership to exchange and have account base, whereas the Brits basically blow that up and created the bearer notes, which then it made it distributed. There was no exchange membership for carrying money. To what extent do you think a retail CBDC is basically a redo of the Brits' innovation as opposed to sort of a Dutch-Swedes exchange account-based innovation?
I think it's a very interesting comparison. That's if you also remember correctly, the Bank of England at the time was not really a central bank. It was a private institution that took over more and more state responsibilities. And I do think we see something similar, especially with stable coins, because the first banknotes, they were also asset-backed. You had gold that you could actually even redeem them for gold. And stable coins are doing something similar. And then what happened in most countries, including in Switzerland, these were all private institutions that issue banknotes, and they all claimed that they were 100% backed with gold. Of course, over the time, the banks figured out that this is a very costly way to do it, and if you cover it with just maybe 70% or 60%, then you can actually do something else with the gold that you don't need to just have to laying there. And of course, that then created the possibilities of bank runs, and you got into problems. And what the state did more and more is regulate, and you to tell the banks you have to have so and so much reserves underlying that. And in the end, finally, the governments or the states, they just nationalized the banknotes, and that's where central banks or note institutions come from. And I wouldn't be too surprised. It could go down the same road with stable coins, because I'm not naming names here, but there are already some issues about stable coins not being fully backed as they say they are, and that will clearly cause regulation. So you will start regulating the stable coins, and if that doesn't work, it could be that the CBDC will be the only game in town. But that's just a possibility. I don't know whether others see it similarly.
Sure. Well, Ms. Long, what are the parallels with EBIT, with stablecoins in general, and the one that you've invented?
Well, we haven't issued it yet, to be clear. Commissioner Forkner has approved it, but we're not operating yet at Avanti, and it is a private version of these. It is a privately issued banknote with Avanti as the guarantor, but storing all the collateral on deposit at the central bank. So very similar to the private stablecoins issued by the Swiss banks in the model. And it does go back to, as you were saying, in banking history, the private banknotes. The biggest challenge with private banknotes historically has been that it breaks fungibility of the currency, because the obligor is the bank. And to your point, back in the late 1800s in the United States, where you had lots of different banks issuing their own versions of a gold-backed dollar, and then it came out that not all of them actually had the gold backing, and so they didn't trade at par. And then what's interesting is we have the technology to be able to ensure that they trade at par now. And so the fungibility is much greater. Some would call those private versions of a dollar-backed token a synthetic CBDC. And I'm curious, actually, for Dr. Moser, have you learned from the technology, the open source smart contract technology that's being used by the stablecoins? And if so, given that that's actually, from a technology perspective, it's proven to be quite durable, surprisingly so. Tether is, I think, 5 or 6 years old now. It's not really new technology anymore, and it's been proven. And boy, oh boy, does it have some interesting characteristics. The on-chain velocity is, about 300 times compared to the M1 velocity of fiat currencies, which is right now in the low single digits. So my question to Dr. Moser would be, why not just adopt that technology and become the guarantor on the note, as opposed to creating your own version of the technology?
I think that's a very good point. I also think, one way would clearly be for a central bank to just issue a CBDC on an existing blockchain.
Mm-hmm.
I think that the big concern still is how do you achieve compliance with KYC AML? Because I don't think any central bank would want to see its CBDC used for illicit purposes. I think that's one of the big challenges. There are some possibilities to do that, and there's a lot of research in cryptography going on, or in the way you set up the architecture. So very interesting, and I fully agree. Stable coins, I think it's fascinating. I actually have a paper coming out on stable coins that we will publish soon, and I looked at different types of stable coins. And as you said, there are some very interesting. You have asset-backed off-chain, asset-backed on-chain. You have algorithmic stable coins. So there is a lot going on there. It's a very interesting field. and in the entire field of decentralized finance. It's just very exciting what's going on. A lot of innovation. Of course, the concern of central banks and regulators is always the risk that goes along with innovation. But in order to innovate, you need to take some risk too.
Right. And may I just follow up, because Commissioner Faulkner is in the weeds on the whole question of how a private version of these technologies can comply with the Bank Secrecy Act and know your customer, anti-money laundering regimes.
Yeah, absolutely. Yeah, we have been into, I think, Dr. Moser's earlier point. Regulation will definitely have an impact on adoption. You can overregulate and pretty much just stifle innovation, right? And I think that's something I'm very much opposed to. But as the regulator, our role is to ensure that things are done in a safe and sound manner, and that the consumers are protected in the process. And then hopefully you blend those two together and the economy thrives. And so we actually looked and spoke with the regulator in Switzerland last year and trying to understand their position on things. And they were very helpful. We talked to regulators outside the U.S. quite a bit in building out our regulatory regime for what we are creating here in Wyoming with our new bank charter. But yeah, the number one concern with anything digital right now is BSA, AML, anti-money laundering, anti-terrorism financing compliance and sanctions compliance. And various organizations around the world have their view on what that should be. I think some of the proposals might be a little, far-reaching, but there's a definitely, you've got to blend those two to make that really useful. And I think we're getting closer. I think we keep asking questions, both internally and externally, and that's continuing to have dialogues back in DC here in the U.S. That will, I think, ultimately help the U.S.'s adoption in this space.
So that's actually a great conversation, because it brings to a point that I see in the feed. The question is, so right now the bank's KYC AML requirements for business, put the requirement is substantial for the system to handle, as opposed to the business to handle the responsibility. Would this, since yours basically incentivizes the merchant or the business to sort of take the responsibility of depositing as fast as possible, would that shift the burden on who's responsible for the money laundering and all the other regulatory? In other words, would the private entities become more of a significant player in that framework, or less?
In that framework that we propose in the paper, it wouldn't really change it. I mean, the merchant depositing, that would all happen within split seconds. But it will still be the banks, so the intermediaries who are responsible for the checks. So that wouldn't lift the burden or anything for the banks. Not in our system. I mean, there are probably, and probably Ms. Long and Mr. Faulkner know more about it. There are interesting developments in technology where you can actually use algorithms and artificial intelligence to take off some of that burden, but I'm not sure whether we are quite there yet.
Yeah, absolutely. I think trying to use it, it's amazing that necessity is the mother of all invention. And I think so the technology for CBDC stablecoins are over here, but you still have the very real world risks of money laundering, terrorism financing that we've had to find solutions for. You are seeing that. I think AI, which now we're learning has its own issues to overcome to ensure you don't have bias built into your AI, but then just the monitoring and the data analytics aspect, that whole market is growing, which I think is just one more tool for people like me in my role and the institutions to monitor and kind of see how these are working, keep the bad actors out as much as possible, and yet still allow for efficiency gains in this space.
Fantastic. So I will ask a question which is related, but probably a little bit off field. As you know, quantum computing, at least the claim of fame for what it would do is that it would basically destroy the known cryptographies that we have today. Not that we have a functional sort of form of it yet, but let's assume that we would get to a world in which quantum computing would be the way to go. How much of a threat would that be to any of this, whether it's DLT based or not?
Well, Ali, I also want to say one thing. So you're delving into quantum computing, which means I've definitely hit the cap of my knowledge base. But I apologize. I had another commitment at 9 o'clock, so I'm going to step off here and leave you in the obviously much more capable hands of Ms. Long and Dr. Mosier. So thank you very much for the opportunity.
Thank you for being with us. Thank you.
Thanks, Commissioner.
Did you want to take that, Ms. Long?
Oh, sure. Well, sure. Quantum computing is a threat to the security of the internet across the board. And honestly, the digital assets are part of that. But the banking system's got much bigger problems if it can't keep data secure because of quantum computing. So it's just a general issue for technology and data security, not just specific to the banking sector, much less digital assets. But the one thing I will say is, having worked with, in one case, a world-renowned cryptographer, one of the Chinese cryptographers who broke SHA-1, which was she wrote a paper in, I think, 2005, describing in theory how SHA-1, the then encryption algorithm that secured the internet, could be broken. And then Google actually did it 11 or 12 years later. It took that long after the theory was put out for someone to actually brute force it and get it done. But one of the points that she made to me is that you often can see these advances coming years in advance. So it took that long for the cryptographers who figured out how to break SHA-1 in theory to actually do it.
No, I think that's a very interesting topic. I mean, it's theoretical, but as Ms. Long said, I mean, that would be a catastrophe for a lot of things. And I mean, cryptography is based on the assumption that some calculations are very hard to do. And of course, so you can break it. You just need enough computational power to do it. There's actually a literature now, and it's very similar to the crypto literature that was emerging in the 1990s. Economists didn't pay attention to that. These were all computer scientists, cryptographers. Now there is a literature on quantum money. I just learned about that recently, and they would actually provide a type of money that is unbreakable. It's really, you can theoretically prove that you cannot break it, but of course they also would rely on they need quantum computing to have that type of money. But there are almost no economists involved in it. People who are interested in that, the only working paper I know by an economist is Isaiah Hull of the Riksbank. He issued a working paper this year. For those who want to learn about quantum computing and quantum money, it's a very interesting paper.
Fantastic. So I have another question that asks, could CBDC technology have unintended consequence of centralizing banks, similar to fall of regional banking and rise of national banking? What's your take on that, Ms. Long?
Well, I have to say, banks are already centralized, right? Every single transaction involving a fiat currency ultimately clears through the central banks. That's how the systems work. And the banks are basically the customers, the direct customers of the central banks. And then all of us are customers of the banks. So it's a two-layered system, but it is very centralized by design. That's just the way the system works. The decentralized technologies don't work that way. And that is why they are so radically different. And they improve on a lot of the drawbacks of centralization. One of the biggest drawbacks of centralization and that multi-layered system is that we have delayed settlement of transactions, and we have, therefore, counterparty risk. If you could settle transactions instantly, you wouldn't have counterparty risk. And because you have to delay the settlement and it has to go through multiple institutions, That's not very environmentally friendly because it's hitting multiple data centers. The same data is hitting multiple data centers. So for those who are concerned about the environmental impact of the financial services industry, I'd say look at the traditional financial services industry, which is literally processing the same data multiple times because each institution has to process it on either side. And so that, a traditional payment probably hits 5 different data centers, right? Whereas in the distributed ledger technology models, it would hit 1 because it's a shared ledger. So that's a side point. But the fact that we have that delayed net settlement, the big cost is to society, because one of the projects that I did with a large corporate that has a global supply chain is look at what it would take. What would be the benefit if they actually had a distributed ledger technology currency available to them? This particular company was based in California and their major manufacturing plant was in Thailand. And it took 6 days to move their own money from their Thai subsidiary to their parent company. And they had a plan for the liquidity for that. The other piece of that is, though, that because they happened to have been a non-investment grade company at the time, their banks required them to hold sufficient cash in all their bank accounts around the world, of which they had 800. They had to hold sufficient cash to pre-fund all of their payments because they never wanted to have a single bank account overdrawn. And anyone who's worked in a treasury of a business knows that the incomes and outgoes of cash, it can be very volatile. And so the challenge with that is that trapped really expensive capital in these bank accounts. And frankly, the banks have a lower cost of capital than that company did. So it's just a deadweight loss on society. We weren't measuring the cost of payment delays correctly. We should be measuring the amount of trapped capital that a business like that could have freed up if they could actually settle their payments same day. And we did quantify just for that particular company to be able to move its cash around the world same day would have freed up $200 million of capital just with its own cash, not much less the cash that was coming in and going out from its customers and vendors.
So that's a great point. So that brings me to, I guess, a related point in that one service that the intermediaries would provide in current sort of a system is that they create bridge funding of various shape or form, and for that service, they charge the service fee for it. If we speed up the payments, then would that fee should be or would be transferred for the claim of fame of a speedy payments is that is lower cost. But if we disintermediate those type of financing, would then whoever is in charge of the payment flows would charge almost equivalent costs in order to just balance things out, or do we on a whole would have gains from speeding up the process?
I mean, that's a good question. My guess would be we would gain. It would lower the costs, but I don't think it's for certain. How the new landscape exactly looks like, it's very difficult to determine. I also think that what interesting is what we talked about before. I don't think it's technology that causes centralization. Actually, technology helps you to decentralize, and DLT is a very good example. It's really economic forces that centralize, and the same thing with intermediaries. As you just mentioned, the intermediaries they provide a service. It can be different types of services. A lot of times, also for consumers, it's convenience. I was struck by, that the big battle cry of Bitcoin was everyone is his or her own bank. If you see what's happening, a lot of people don't want to be their own bank. They want to have someone who takes care of their stuff. They want to have a wallet provider or an intermediary. They want to have convenience. And that causes this centralization. So it's economic forces, liquidity, exchanges, they need liquidity. So I have a lot of sympathy for these attempts to decentralize. I have a lot of sympathy for the decentralized finance ecosystem, but it's very difficult to do that because economic forces always seem to push towards centralization again.
All right, so let me do a segue. There's a question here that it says, will the underlying programming of CBDC be made available to public before that programming is enforceable. So something that you said that the code would then be open for public viewing, and that makes it a better code, so to speak, more secure. The backbone of internet has that flavor, but at the same time, it also opens up the sort of a bad players also see how things are done. So to what extent the counterbalance between the broad knowledge, the distributed knowledge, counterbalances the bad actors?
I mean, there are always bad actors, and that's a big challenge always. But I don't think that open code will be good for bad actors, because I mean, there is this saying in cryptography that says, security through obscurity is a very bad way to get security. It's like hoping that people don't see how it's done. It's much easier, and that's where also public key cryptography comes from. Show it. But make it very difficult to break it, or almost impossible. And that would be kind of the way to go. You have an open source code, you show everyone what you're doing, but you have other features in there that protect you. You don't have to rely on people not finding out what you're doing, which also is very bad for trust, especially on this privacy issue, which is a hotly debated issue. But if you tell the people you have a certain amount of privacy, and I think that will be an issue. Then if you say, just believe me, trust me, you will have privacy, but I don't show you how it's done, you don't convince everyone.
Sure. So kind of related, you mentioned that your proposal has a maturity for the CBDC. Do you envision a set maturity, or do you envision something that is fluid? One of the reasons the old currencies, for instance, get out of circulation and come back has to do with security. That when you see there is too much of fake money, floating around, then it's time for a reboot. So, in this case, I guess if we think that they're catching up with the cryptography technology, then you have a newer version that you can implement. That's the good time to basically take the old one out and then bring something new in. But that's a fluid maturity date, as opposed to saying every 2 years we're going to reset and start. What's your thought on that?
I mean, it could be, so that's a design feature that's just in there. You can use it or you cannot use it. You can do it fluidly, that you say, we will just say it will expire within the next year or so, and you could set that basically whenever you want to set it, or you could have a schedule ahead. They're really different. I mean, as you say, there are different options to do it. So the security part is one, and the other is that growing list. If you have, so that the central bank, the only way to provide double spending in our system is to have this list of spent coins. And if that's growing and growing, and the computers have to search through a longer and longer list, it gets slower and slower and slower. So that would clearly be an argument for having a schedule that you say every 2 years or something like that, depending on how much transactions. But that's totally flexible in there. It can be used. It doesn't have to be used.
Dr. Ali, may I pick up on that? I think that's the biggest challenge with the proposal, because that will scare people. The concept that the user might have their money expire. Cash doesn't expire, right? I mean, your point is well taken that physical bills do have to be reissued, and they are reissued with a new serial number, but they're fungible with the old one. And most folks don't even recognize that is happening, don't even think about that is happening, because the old bills in most countries are still honored. That's not always true. And I think that's really important. The US has never actually not honored old versions of bills. And I believe Switzerland also is in that category. In other European countries, old versions of bills will actually expire, and they will be dishonored. So maybe in some countries that would be accepted, but in the US, where there's not been a history of stopping to honor old dollar bills, you can always exchange them for new ones. They will always still be worth they're always worth $1. So how does Switzerland think about this, especially given the history of the Swiss banking system, the huge role that it has played historically, and especially with Swiss privacy as well?
No, mate, that's a very, very well taken point. Actually, in Switzerland, it's just from this year on that the old money will be honored. Before it also expired, but
Interesting.
it just changed. But I think it depends. I mean, it's a trust issue, and it depends how you do it. So you really need to announce early enough that it's going to expire, and then you need a long transition period. So in Switzerland, it was like 20 years. So you have 20 years time to exchange it, and still, some people missed it, and then there were issues, especially people abroad who were hoarding Swiss banknotes. But no, I fully agree. This is an issue that would have to be handled very carefully.
May I also ask another question, Dr. Ali? There was a very interesting announcement that came out yesterday from one of the GSIBs, a global systemically important bank, of which there are 2 in Switzerland. One of the US ones announced that it is getting into foreign exchange trading of cryptocurrencies, and will be providing lines of credit to their customers on cryptocurrencies. And I was pretty outspoken that this is insanely risky because there is no lender of last resort in the cryptocurrencies that have a finite amount. And someone challenged me, rightfully so. Well, that's true of gold or Apple shares or any other asset that has a finite amount. And I started really thinking about what's the difference? Why is Bitcoin different? And the answer is because there is no clearinghouse in Bitcoin, whereas with gold or with Apple shares, the clearinghouse that owns the true collateral is within the banking system. But that's not true of cryptocurrencies. And so I wonder if, given the forward-thinking nature of the Swiss National Bank, if there isn't going to be a drive toward actually, especially since the Swiss banks can provide deposit services for cryptocurrencies, will the Swiss National Bank become a clearinghouse for cryptocurrencies to execute your lender of last resort function by actually investing some of the Swiss National Bank's reserves in cryptocurrencies?
We are asked that a lot, but we are not ready to do that.
Okay.
We are not there yet.
It's true. There is no clearinghouse for cryptocurrencies, and that's the biggest risk for the big banks getting in and doing this on leverage. There is no lender of last resort.
And I mean, Bitcoin, in general, it's a very interesting concept. I mean, there are a lot of things are different with Bitcoin. That's also why I got very early interested in Bitcoin before most people, especially central banks, started to think about it. But it's just fascinating what's happening.
So someone asked a question, which I'm going to expand on it. So someone asked a question that the way the Chinese CBDC works is that you would deposit it and then it can be converted to the normal money. Now, I'm going to expand on that. One of the reasons I think perhaps the reasons why Europeans, Switzerland, Sweden, have been more receptive of the idea of digital money somewhat has to do with demographics. The adoption rates of new technologies have been faster at the younger sort of demographics, and they're percolated faster. To what extent do you think that demography would play a role in how things are going to be adopted? So I'll give you an example. My father-in-law was very mad when they're trying to schedule vaccination for COVID vaccination. And part of the reason was that many of his, people that he hangs out with don't necessarily go to internet. The only thing they know is phones. And the system was just set up the way that you had to go to internet and you had to schedule everything on internet. And his generation is not a small generation. They're large. So to what extent we could expect pushback from countries that have very large older generations for adoption of all these things, digital, including CBDC?
Mm-hmm. No, I think that's clearly a fair point. And we see also when we make our surveys that the younger generation is using digital payments, whereas the older generation still uses a lot of cash, especially in Switzerland. But at the same time, don't underestimate how quickly people can learn.
Sure.
And I mean, one was now during COVID, pandemic, when most people were encouraged to make contactless payment in Switzerland, people learned very quickly, and it will be very interesting to see once this pandemic is over, how many people will switch back again to cash, and how much will stay the way it is right now. And that, I mean, you brought the example of your father-in-law. I look at my mother. She's not very literate on the internet, but she has. I got her an iPad, and she has a game there. She likes to play cards on that. She learned that she's like the fastest card player on that iPad now. Just people can learn if they're interested. Then they learn quite quickly.
So someone asked this question, which obviously is one of the greatest beef with Bitcoin and other DTLs, which is the energy use. CBDC needs to consider energy use, carbon footprint, et cetera, et cetera. Personally, I didn't see anything in your proposal that it requires a lot of energy. But what's your take on that vis-a-vis other criticisms of obviously Bitcoins and the like?
I mean, that's a very interesting topic, and with Bitcoin, it has to do with that consensus mechanism. And the interesting thing is in Bitcoin, sometimes that's considered to be a flaw. And actually, it's as they say in IT, it's a feature.
Agreed.
Because it guarantees the security. That's the way you make it secure, that you make it extremely computational expensive to try to redo one of the payments. So it's really a feature of the system that gives you the security, but it uses a lot of energy, and that's why a lot of DLTs try to have a different consensus mechanism. But you lose this very high security of Bitcoin. Or the other way is to have it like I said, with this permissioned ledgers, where you have a very small amount of nodes. It's a very centralized system. Then you can also reduce the energy consumption quite a bit, but you lose the decentralization. So it's a very tricky issue. But I don't know, Ms. Long, do you want to add to that?
Well, that's interesting, because we talked a little bit about this earlier, that actually, if you truly measured the carbon footprint of the financial services industry, it's probably the worst industry in among the different industries, because of the fact that it is the biggest user of data center capacity. And what is the biggest fuel used to create the electricity to run data centers? It's fossil fuels around the world. And what I specifically mean by that is, as we were talking earlier, an average transaction is going to hit at least five different data centers: the central banks, and then the sending and receiving party. And then you've got the auditors who are accessing that information. If it goes through a correspondent bank, if it's foreign exchange, you're going to be doubling the number of data centers that's processing that exact same data. If we really took a hard, objective look at the carbon footprint of the financial services industry and measured it that way, all the office buildings that leave their lights on overnight, right? All the operations staff whose job it is to sort out the mess of failed payments because the ledger systems are never in perfect sync with each other. The whole concept of shared ledgers is shared infrastructure. It is processed only once. It hits one data center, and everybody, including the auditors and the consumers, can check their balances there. That's a powerful concept. And I agree with Dr. Moser. I praise you for defending proof of work. That is what secures these public blockchains, proof of work. And absolutely, I'm unapologetic about it. If we really measured it, we would see it is more efficient. And the other piece is, of course, in the Bitcoin and Ethereum networks, the majority of the power that's consumed is waste energy, because what we now have is the ability for energy to be mobile. So specifically, some of the hydro projects in China, where no transmission was built next to the power generation, that power would otherwise be wasted. And what Bitcoin and other cryptos that use proof of work as their consensus mechanism, what they're able to do is turn that waste energy that otherwise would be wasted into something of economic value. That's happening with the Icelandic geothermal plants that were built next to aluminum smelters that are no longer operating, the Bitcoin miners moved in. We're seeing it here in the state of Wyoming with flared natural gas. You used to see the little flare burning off the natural gas in an oil well because they had no way to capture that. Well, now you actually see these little huts right next to the oil wells, and you don't see the flare anymore because there's a Bitcoin mine right there. And so you really, the headlines are true. It is true that Bitcoin uses, I just saw a recent one, Bitcoin uses as much energy yearly as Switzerland. That is true, but you really truly have to be, you peel the layer of the onion back both on the source of power and comparing it to the traditional financial services industry and realize there's actually a really good story there. It just happens to be one of the many attack vectors, one of the many pieces of so-called FUD, fear, uncertainty, and doubt that hits the crypto industry. But there's a reason why the crypto industry hasn't died yet.
That's
It won't.
That's a fair point. Yeah.
So we're getting a little bit closer to the end, but let me ask. So there's a question here that says, have the CBDC designers consider consensus mechanism that considers a proof of a stake is spread across regions, countries, and would this be then incorporated into a government token? From what I saw from your presentation, there wasn't necessarily anything like a POS or proof of work or anything like that. And that was your whole point, that you wanted to sort of short circuit that process in order to make it faster.
No, exactly. And I mean, I want again to stress that I'm not against DLT or blockchain. I just think it's always important to think, do you need a blockchain or do you not need a blockchain? And with a CBDC, you can go both ways. So the proposal I made, for a pure retail CBDC, that would be without the blockchain. So you don't need a consensus mechanism. It's purely centralized. But if you look at the proposals out there for a CBDC on a DLT, that is provided by, for instance, Corda or a Hyperledger, they are very centralized, and you also have you almost to the extent that you don't need a consensus mechanism anymore because you have basically this one notary node there or a validator node that is very centralized way to validate transactions. So you don't need a complicated consensus mechanism. You only need that if you want to really keep the decentralization.
So I guess I'm going to ask one of the last questions. So I'm of the belief, and I don't think that it's far-fetched, that one of the reasons dollar has such a prominence is that post-war World War II, the payment systems, whether by choice or quasi-choice, were forced to use dollar as the base currency of payment transfer. That includes, SWIFT, ACH, and all the major ones. I'd imagine that the new emerging superpowers want to undo that. Would CBDCs maintain dollar supremacy or allow for something new to come up?
I mean, that's of course we get here now into geopolitical topics. I mean, as you pointed out, I mean, it's clearly if you go way beyond World War I, then it was the British pound. Something happened around World War I, World War II, and as you mentioned, it was clearly the rise of the U.S. as a superpower, but also of the U.S. financial systems. The banks play a very important role. If you want to make cross-border payments, you will have to go sooner or later through a U.S. bank, which also encourages, of course, the use of the U.S. dollar. I think that's one of the probably interesting issues. If you look at Bitcoin to some extent also was, a big selling point was that it's censor resistant. Exactly that you can basically make payments without having to go through a U.S. banking system, which reduces the possibility to intervene and through sanctions, for instance. And of course, the Chinese CBDC would also be able to do that, but it would need to have wide adoption outside of China, and I think that's not really guaranteed.
Well, thank you both. We're getting close to the end of the hour, so if you have any concluding remarks, please go ahead. Dr. Moser?
Okay, no, thank you very much. That was a very interesting talk, and I think it's worth to watch what's going on with CBDCs. Most central banks are now researching it. I also think we will see some real world examples. It will not be as fast as some people expect, but I think we reached the point of no return. I think it's clearly going into that direction. So it's going to be interesting to see what's happening over the next years.
Thank you. And Ms. Long?
Yes, thank you. Actually, it's been an honor to be with you both this morning. Dr. Moser, 20 years ago, I spent a year working for Credit Suisse in Zurich at Paradeplatz. So thought a lot. And right about that time was when the vaunted Swiss banking privacy was being removed after 9/11, and the United States sort of forced that. And I always thought that was an unfortunate decision for Switzerland because because it was a direct attack, in my opinion. I'm speaking as an American, but so again, not taking a view that it was a direct attack on one of the native industries in Switzerland of which it was so proud and had a premier position. And I've always thought that the Swiss embrace of crypto was a way for Switzerland to grab that back. And so I commend you for everything you've done, really, truly. As I see what's happening, China gets so much of the attention, and of course the Fed, because the dollar is the reserve currency, but the action in terms of really, truly forward innovative thinking has been happening in the Swiss National Bank. And I encourage you to keep going. I'm rooting for you as someone who spent a little bit of time there and really does appreciate the power of the Swiss private banking industry, and hope that you're able to get the supremacy back, and would encourage you to do it by taking some of the best attributes of the public decentralized cryptocurrencies, which are, I think, not going away and are certainly creating interesting challenges for central bankers who are trying to figure out what's the responsible way to plug them into the system.
Mm-hmm.
Thank you. Thank you both. It's been an honor, privilege to have you both here today. I thoroughly enjoyed it. And I'm sure our guests here share the same sentiments as I see they do. And with that, I bid you well, and I'll pass the mantle back to Dr. Lupien again.
Well, I want to, first of all, Dr. Ali, I very much want to thank you as well, too, for really creating this event, and for your wonderful job moderating. Dr. Moser, thank you so much. Ms. Long, amazing the things you're doing here in Wyoming. And I just want to remind everybody that the Wyoming Stampede is coming up at the end of September. It's going to be running the 22nd through the 25th. It's going to begin with our two-day meeting of the Wyoming Legislature's Standing Committee on Blockchain and Digital Innovation, which is always fascinating because you can see where Wyoming legislation and legislators are thinking for the future. We will be conducting one or two more of these mini events in advance of the Stampede, so we'll certainly keep everybody involved. So Dr. Ali, Dr. Moser, Ms. Long, and certainly in absentia, Commissioner Faulkner, thank you so much for your participation, and we look forward to speaking with you all again. Thank you, everybody, and goodbye.